So a lot of investors love doing development deals with new projects, starting with raw land or taking existing properties, tearing them down and building new ones. And my friend Victor Menasce has been doing this for years. He's really a pro at it. I've seen a lot of his case studies where he's been doing a great job at it. And I wanted to just bring him on to talk to our passive investors about what it looks like to invest, especially today in development deals, kind of how it's changing, particularly when it comes to lending. It comes to all the different factors related to it. So Victor, how are you today?
Great to be here.
Hey, really excited to have you. I know you are an expert in this. I know your book, Magnetic Capital, and you also have the Real Estate Espresso podcast, which I had a chance to be a guest on a while ago. It was really fun. But why don't you give people a little bit of background about yourself and I know you were a Silicon Valley engineer and you have some cool stuff you've done there. Or just talk to people about your journey of how you've got into development over the years.
Absolutely. Well, my path into the world of real estate investing was definitely not the typical path. I started out my career as a microprocessor designer, electrical engineer by training, and designed chips that are used initially in the telecom network. So about 52% of the phone calls in North America were by a chip that I designed from much of the 1990s, and just progressively rose through the ranks at both public and private companies, always doing some form of microprocessor design, whether it was chips used in control systems. And I've got chips all over the world in all kinds of weird and wacky applications, everything from seat back displays on Airbus aircraft to a chip in the Patriot missile, chips in the Pachinko Apache slot machines in Japan with Sammy Sega and NVIDIA, storage networks, fiber channel switches. I mean, the list goes on and on of different weird and wonderful applications. And some of the most fun I had in my life. I mean, it was about the 20th trip to Tokyo in a year and a half. We were building a new cellular network in Japan with a number 4 carrier in Japan, which for them is a small company, but for us was a huge company. And it was just starting to burn me out physically and emotionally, and it just wasn't the right thing. That 13 to 20 hour trip to Tokyo every few days was just not the right thing for me. So I decided to take a hard left turn in my career. The date was 2008, 2009. Something was happening in the real estate market, if you might remember at that time. And it
Oh
just
yeah, there
seemed
was
like,
that thing, right? That thing
yeah,
happened
that
in
little thing.
2008.
Yeah. Yeah. It was a
Yeah.
good time to be playing offense in real estate and not a great time to be playing defense. So it was a good time to jump in.
That's great. No, I remember I read some of your story on your website, how you were traveling a lot. I mean, the 20th trip to Japan in a year or something, or what, yeah, that just sounds intense. And so you started to get into real estate. You started to realize, hey, this could be a good fit. And it sounds like things went really well for you very quickly. And I think a lot of people have that experience, but you've done just an awesome job at that. But talk to us. And it's interesting. I wanted you to talk also about um, development, kind of how you got into development. And for some investors, like they're either like all they do is development
Mhm.
or they don't touch it at all. And I honestly, I'm a little more on the like, I don't touch it at all. I would be open to it if it was the right deal and it made sense. It's just I haven't done it, right? So a lot of times we go with what we know. But can you talk to us about what it is about development that really spoke to you and kind of how you got started over there?
I would say that, well, first of all, I want to dispel any myths. I wasn't absolutely successful day one. I made a lot of mistakes. I stepped in a bunch of potholes, partnered with the wrong people, wasted a lot of time doing things that, quite frankly, were um, starting at the bottom of the industry in many ways. I started flipping houses. And when I look back on that in retrospect, I kind of scratch my head and go, Victor, what were you doing? What were you thinking? And I forgot so much of what I already knew from my prior career. I'd done one IPO and 5 M&A deals, and here I was spending my own money and not raising capital and doing small deals and made all the mistakes you could imagine. And then once I had to relearn those things very humbly that I thought I already knew, it was that's when things started to work and things started to take off. So we started development really progressively in Philadelphia. At that time, you could buy things for well below the cost of construction. So of course, it didn't make sense to build. It didn't make sense at all. But what we were doing is we were buying properties that were really in derelict condition. We would demolish the inside of the building, put a new building on the inside, and keep the external structure. And so we were delivering new product at a time when the marketplace had a pent up demand for new product. And we're not talking light rehabs. A lot of people were doing renovations, paint and carpet. And this is putting a whole new building on the inside with modern amenities and, modern energy efficiency in the shell of a 100-year-old building. And so the step from there to new construction, some of these structures were just not worth salvaging. So we did demolish them completely and built from the ground up, but we bought them cheap enough that it actually made sense. And then the step from there to going to zoning and asking for increased density was a small step. Then the step from there to doing small land assemblies and getting entitlements on those land assemblies was a small step. And then the step from there to entitling a piece of land and building ground up was a small step, and so on. So every step along the way added another piece to the puzzle that made it possible to become more and more expert as a developer. So today we're doing much larger projects, residential subdivisions on a fairly large scale, ground up construction in multiple asset classes, senior housing, storage, apartments, and of course, residential subdivisions. And what's been unique about that, in particular over the last couple of years, is, as you know, it's been a feeding frenzy. It's been everything that comes on the market seems like it's an auction. Now, fortunately, the auction's over, but I don't ever want to be the winning bidder in an auction environment. I want to be the only buyer at the table.
Right.
And when you're conducting new development, there's no competition for the idea that's in your head because it's not out there. There's nothing out there with a flashing red light on it saying, here's a deal, come get me. It's whatever concept you come up with for what the highest and best use would be for that particular opportunity. And so that eliminates the competition. We found that for several years, since probably 2014, 2015 onward, we could build for less than things were selling for in the open market. So it made sense.
Right.
And when I say less, I mean quite a bit less. I think that's still often true today, even though the market conditions have changed. So that was really the driver to get into development. Plus, we went through a period of 5, 6, 7 years where there was a shortage of new construction. And so there was a lot of pent up demand for new product. And that just, continued to create value for clients in those respective markets we were investing in.
Yeah, you brought up a couple of things I wanted to touch base on. You mentioned, when you started, you did, you bought older places and just basically put a new building on the inside. And then you kind of added in other things. And there was other entitlements and things, and you started tearing them down. And you kind of learned the next thing. And I think that's a very applicable thing for a lot of investors too, is that, hey, I don't know much about real estate. Well, and you start getting involved and saying, well, I'll get in this development deal. I'll get in this multifamily deal. I'll get in this other thing. And then all of a sudden you've invested in all these different things and you learn in the process of doing that, which I think is awesome. And then now, like you said, you're doing all these different things now. I wanted to touch base on something that you've mentioned. I've heard you speak at a couple of events, talk about this concept of buy on the line and change the line. So the idea of strategy of kind of where you're buying, right? If you buy in a really great neighborhood, it can be really expensive for everything. But if you're buying on the edge of that, or maybe just outside of it, the comp kind of process is interesting because it pulls comps from the area, maybe that's the more desirable area. So can you talk a little bit about that kind of, change the line strategy?
Yeah. We call that strategy buy on the line, move the line. And that line, for the listeners at home, you can visualize wherever you reside, that line exists. I can virtually guarantee it that on one side of that line is the hot gentrified neighborhood with the coffee shops, maybe the art galleries, very walkable community. And then you go a few blocks too far and you're in the hood. And virtually every city in America has that situation. Now, often that line is completely arbitrary. It doesn't exist for any particularly good reason. And if that line is arbitrary, that line can often be moved. You can often purchase property on the wrong side of that line for maybe, hopefully, pennies on the dollar. That used to be the case. It's less the case today. But you can buy that property at a discount, redevelop it, and now the line is on the other side of your property. And you can, of course, do that again and again and again. Now, if you just do one, it might not be enough. The market might not get it. But if you put a little scale behind it, you might do 2 or 3 or 5. Now, all of a sudden, the marketplace takes notice and says, oh, the line has moved. Now, when you go to get a valuation on that property, there are no comps for new product in the hood. So the appraiser is going to have to look to the other side of the line. Now, they may not give you 100 cents on the dollar when they give you that appraisal. Maybe they'll only give you 95 cents on the dollar. But if you bought that property at a sufficient discount to the market, you can create an extraordinary amount of value. And then progressively over time, once the market solidifies and gets that line is moved, you're going to get 100 cents on the dollar for being now within the envelope of that hot gentrified neighborhood.
Yeah, I think that's a really cool concept, is that, sometimes there are lines based on, at least in where I live in LA, there's city lines, if you're in a certain school district or you're outside of it. So that's, I guess, a line that's in place. But a lot of times there's no real specific line. If you buy across the street, like you said, over time, it will start to recognize, hey, this is actually part of this other great area. So I think that's a really cool strategy. Can you talk
Absolutely. I mean, if that line is an immovable line, if it's a hard boundary, then that strategy may not work. For example, if you're west of the 405, between the 405 and the water, values are going to be higher than if you're going to be east of the 405. That freeway is a boundary and it's not going to move. So don't think that you can hop the freeway and get the same values from the other side of the freeway. That's not going to work. But if it is truly block by block and you're not traversing a school district or a municipal boundary or something like that, it's truly an arbitrary line, that's a movable line.
Yeah, no, that's awesome. And I think that's things people don't realize about real estate, is that areas perpetually change. And we've watched that the last 10 years. Just, you probably, even if anybody listening in your own home area, especially if you're in a larger metro, like, things change and they change dramatically. And if you can get ahead of kind of the path of progress, and that's what I see a lot of developers do, right? They go into areas, especially we've seen this in LA, where we don't buy anything in California, but I watch it, where people go into these areas that were really rundown areas, and then you see it start to change. The artists come in, they start to do the coffee shops and the gallery and all. It's just kind of a standard thing, but then you see it, and then some of these values have gone crazy at 4 or 5 times what stuff was just even 5-10 years ago, which has been interesting to watch. So I think something that's really interesting about your story, Victor, is that you live in Canada, but you're doing a lot of development in the US. So are you traveling all the time, or how do you, like, just as an individual, how do you manage that? I know you have partners, and I know some of your partners as well, which are great people, but how do you manage that process, I should ask?
It's a funny thing. When I started my career in technology, I was working with people that were in far-flung cities right from the very start of my career. So it was something that became very natural to me, even though it's perhaps an unnatural thing to do for most people. So when I switched into the world of real estate investing, of course, it made sense for me to be doing something that was not within a 10-minute drive of where I lived. That was never a barrier for me, because if I was, not a problem for me to fly to Tokyo or to Korea or to Taiwan. I mean, it was never, ever an issue. And I just never saw those boundaries as obstacles. And so it was no different in real estate. And in the world of tech, I was managing, when I was running the microprocessor organization, I had 13 design centers reporting to me from all different time zones. And I was in the wrong place for somebody all the time. So it really didn't matter where I lived. And I just took that with me, took that skill set of managing remotely. And as it turns out, managing construction is actually a whole lot easier than managing chip design, because you can't really tell if there's a problem in a chip without going through a tremendous amount of analysis. But boy, if the windows aren't in, that's pretty straightforward to figure out. If the countertop isn't level and an egg's going to roll onto the floor, you can figure that out very easily. So real estate development's a whole lot easier than chip design.
Yeah, absolutely. Well, it's interesting too. There's so many, particularly on the, like, operations or deal finding or development side. I see a lot more engineers or people with an engineering type of background, that it's all about processes and systems and all of this stuff. And I know our friend Robert Helms talks about, in real estate, you can live where you want and invest where the numbers make sense. And so I
Exactly.
do that as well. Like, I live in California, and we have 1,500 units in Jacksonville and 500 in Atlanta. Like we do a lot of stuff out of area because it just makes much more sense. So I love that you're doing that. So for someone that's unfamiliar, has not invested in development deals, obviously I would think, just kind of the way I look at it is that, you are taking the risk really is that, it takes a little longer to develop, right? So versus a multifamily or a value add kind of existing deal, you come in and you can kind of do things pretty quickly. You got income. It could take you sometimes years before you actually are generating revenue or you're able to sell that property. But what would you say some of the things that people should look for when they're looking at new development deals, either risks or way they evaluate sponsors, or just what are some of the things to consider before getting into a development deal?
Absolutely. And the risks are significantly higher than they would be in a pure value add or an existing stabilized asset. There's no question about it. The risks are entitlement risks. You might not get the permission that you're hoping to get to build that density in that location. And there could be all kinds of pitfalls. Maybe you don't get a curb cut where you need it to get in and out of your property. Maybe the city wants a traffic study and they don't want that density because the roads can't support it. There can be all kinds of different reasons why a municipality might say no to your concept as you've conceived it. So there's absolutely entitlement risk. There's the risk when you get into construction that it could end up costing you more. Maybe you haven't scoped the project properly. Maybe there was an error made by the architect or an engineer, or maybe the person estimating the construction made an error. There's lots of opportunity for those types of errors to creep in. And then finally, when you've got it fully built, hopefully on schedule, on budget, you've got absorption risk. Are you going to get it leased up and stabilized within the time frame that you want? And then, of course, you got all of the capital risks. We've certainly gone through an awful lot of that this past year with the increasing cost of capital with higher interest rates. Now, there are things you can do to mitigate all those. And today, for example, we've put a number of construction projects on hold because we couldn't mitigate the cost of capital. I don't know if you have a crystal ball, but my crystal ball cannot tell you what interest rates will be in 24 months when we would convert from construction financing to permanent. If it goes our way and interest rates continue to be negative interest rates, it's awesome. And when I say negative interest rates, I mean negative real interest rates, where the interest rate charged to the money is less than the cost of the consumer price index. Those are still negative interest rates, because in an inflationary environment, three things happen. First, the purchasing power for people on fixed income gets wiped out. Number two, savings get wiped out. And number three, debt gets wiped out. So if you know that, how would you structure things to take advantage of that environment so you come out on the winning side of that equation? And negative real interest rates or even just being in an inflationary environment, that debt's going to get devalued over time. And the benefit of inflation always goes to the equity holder in the equation. So we know that long term, all of these deals, even today, even with increasing interest rates, even though we pause the projects, we know they still make sense. We know in our heart of hearts, and we can prove it mathematically. What I can't prove to you, and where I'm not willing to take the risk with investors' capital, is I don't want to be upside down when it comes time to actually convert from the construction loan to permanent. It's got to be lower risk than that, which is why we put a lot of stuff on pause right now until we can stabilize the environment. The macro environment is dominating so much of what's happening today, and we want to be in more control than just the whim of what Mr. Powell is going to say next week.
Right. Yeah, and that's right. I mean, that's a lot of what's driving the market right now, and it's interesting. And I think development, like you talked about, there are more risks there, but if you can mitigate them, obviously that is very important. So when you put a project on hold, how does that work? You have investors in the deal, and you're just saying, hey, we're going to wait until once we actually start. So you have some carrying costs, but it's less than if you're doing the whole deal and you're kind of doing everything
Absolutely.
yourself, right?
Yeah, it's really all about protecting, keeping investors safe first and foremost. And of course, the project was launched, the capital was raised with a forecast and an expectation, and it feels terrible to go to those same investors and say, you know what? The future did not unfold the way we hoped. And while we are aiming for this internal rate of return or this equity multiple, it's going to take longer, and that's going to pull the returns down. And that feels terrible, and it creates anxiety with the investors. Some of them wonder what their actual rate of return is going to be. Probably some of them, in the absence of information, are wondering, are they going to lose their money? It creates fear and anxiety. There's no question. But it's all about protecting the investor, making sure that we're not carrying, our carrying costs are under control for these projects, so that we keep investors safe. I still, in my heart of hearts, feel very, very comfortable and confident that these are solid projects. And then, of course, we have other projects that are not necessarily new construction today, but are perhaps entitlement projects where we're creating value by multiplying the value of the land through entitlement. Because if you think about land value, it's largely tied to what you can do with it. If you think about agricultural land, it might value somewhere between, let's say, 4 and 10,000 an acre, pretty much anywhere in the country. If you can put a 40-story high-rise building on that, it could be millions per acre. So it's really tied to, of course, market demand, but also what you're allowed to put on it. So we can get a very large multiplier on the land value simply by going through the entitlement process, and then, of course, bringing some of the necessary improvements so that you can get that product built on that site. And that's something that spans economic cycles.
Yeah, absolutely. Yeah, it's interesting to just look. Every asset class has its own set of risks and challenges, especially today when we've watched investor sentiment. I feel like there's still some great deals out there in multifamily value add stuff. It's just the sentiment has changed a bit. Of course, there's the wealth effect too, where people have lost some money in the stock market. So there's investor appetite has changed a little bit. So again, I know you mentioned 24 months from now, it's hard to predict. I won't hold you to this in 24 months, but do you have any ideas on kind of where we're headed or what you think things are going to look like? And especially when it relates to investment, what are some of the best moves people can look at doing these days when, things are, like you said, projects are being put on hold? What are things that you're looking at either in real estate, out of real estate, in development, out of development? Just would love to know.
Well, there's no question there's a flight to safety. And in an environment where there's seemingly very little safety to be found, there's not much safety in the stock market overall. There's certainly no safety in the bond market unless you're buying very short-term instruments, because as interest rates go up, the value of those bonds go down. So what has been traditionally a safe haven in today's environment is not. There's question marks about value of certain real estate and whether that's a safe haven. I think for the most part, it's more stable and it'll hold its value better than most other things. The big winner this year has been investing in oil, believe it or not. The folks who invested in certain commodities, oil being one of them, have done very well. And I think we are going into a period over the next decade or more where certain commodities are going to be in short supply, and energy is a big one. It's a huge one. So I think there are some targeted investments to be made in energy for sure. I think that in real estate, there's still absolutely, and we're still very active. We are looking for ways to reduce risk for our investors. So, for example, if we can rate lock our construction and permanent financing at the start without being forced to do a refinance in the middle, if we can rate lock, we'll do it. If the numbers make sense, we'll do it. So we're looking hard at those types of opportunities where we can rate lock. That's both in Canada and the US. They're not as easy to do, but if this business was easy, everyone would be doing it. So those are the types of things that we look at. There seems to be a flight to safety into treasuries. But again, I think the only safety there is in short-term, very, very short-term T-bills.
Yeah, I think there definitely is a flight to safety, and a lot of investors are just trying to figure out what to do. And I think anybody's a real estate investor. If you weren't paying attention back in 2008, 2009, or before then, maybe 2006 to 2007, you could have lost everything. And there were a lot of people that did. And so it's paying attention to these macro factors, the economics that are going on. It's so important. So I think paying attention to all this stuff is really critical.
I think there will be a ton of opportunity over the next 6 to 18 months where there's a lot of folks that made what, in my estimation, are very risky bets, where they paid far too much, meaning they bought it far too low a cap rate. They purchased with bridge debt, where they're not going to have the ability to convert into permanent financing without bringing a ton of additional equity to the table. And, those are difficult conversations for those folks to have. They're either going to be trying to do a massive capital call with their existing investors, or they're going to try and raise additional capital in a manner that's going to be dilutive, or they'll be handing the keys back to the lender. So I think there will be a fair number of distressed opportunities in the market of projects that are probably half complete, 3/4 complete, maybe even 90% complete that couldn't refinance. And the key is to be sitting on cash, to have that liquidity, to be prepared to invest at a fairly low ratio and get the asset stabilized, and then put up your head after a period of time and get into more aggressive financing when the numbers make sense.
Yeah, it's interesting. There's a lot in the multifamily space. I think it's about 85-90% of debt for large multifamily is bridge debt. And so just having, we're seeing it particularly some of the, I think some of the newer, nicer properties where people get to a place where they just have to sell, the debt's coming due and they've got to sell it. And so if you are able to take advantage of that, or people, it's really when they have to sell is the time when you can really pounce. So I think that's great. Victor, I wanted to just really appreciate you for the value that you add to the real estate community. You really, and I've heard you speak, a number of times, and you're just always adding something of value for everyone. So really appreciate that. And I want to encourage everybody to check out your podcast, the Real Estate Espresso podcast, as well as your book, Magnetic Capital. So how else can people get in touch with you or follow you?
They can connect with me directly through the website at victorjm.com. That's victorjm.com. And thank you for mentioning the podcast. The Real Estate Espresso podcast is a daily show 7 days a week. And it is literally your morning shot of what's new in the world of investing. So the weekday shows are just me, 5 minutes. And we really just focus on one thing in each episode. And then the weekend edition are interviews with notable people from the world of investing, including yourself.
That's awesome. Well, thanks so much, Victor. Really great having you. And I look forward to seeing you at an upcoming event here soon.
Thanks so much, Bronson.
All right. So Victor is really good at explaining complex topics. If you hear him, he just explains this stuff. And if you're watching the video, it's like he doesn't even flinch when he's talking about these complex things. He knows it inside and out. And I think that's something that people don't realize when they come to real estate, they can bring their background to what they're doing. I mean, for me, I kind of wondered, how am I going to get involved in real estate? Like, I've been a sales guy and medical sales for years. And I was thinking, okay, I love analyzing deals. Maybe I'll be a deal finder. I'll find deals and I'll find a way to bring value. But of course, when you have over 10 years of sales experience, talking with investors and presenting information is very easy. So that's really what I spend a lot of time doing now. And now after 1,300 calls with investors, I've realized that's been a real resource. So for you, even as a passive investor, learning to analyze deals, if you have a business, it's very transferable, because all a multifamily real estate deal is, or a development deal is a business, and there is a business plan. It's called a pitch deck, right? So bringing that in and trying to understand a deal. So Victor mentioned a lot of things. He talked about, the move the line strategy, or, basically where you identify the line, you buy on the line, then you can move the line. I think that's a great idea. And, when you talk with people, you can always pick up something interesting, especially if they've been doing something in that world for a long time. But I did think it was interesting to say, he said some of the development stuff they're putting on hold right now to make sure that there is some certainty later. And that's one of the challenges of development deals, is that there is more risk, because you don't know what's going to happen in 2 years when the economy changes or things like that. For that reason, I've been a little more cautious for it, but I have friends that's all they do. And some people have done phenomenally well. So, encourage you, if you are interested in that, check out Victor, check out his podcast, his website. He's got other things he's doing. Follow him. Anyway, I really appreciate you taking the time to be on this show. One thing we are actively working on, we're working on some new deals. By the time this comes out, we should have some new deals out. Also, the Mailbox Money Show. If you would please do me a favor. We had 7 reviews on. We have a lot of people listening. We just don't have any of you reviewing. So if you are getting value from this, would you please just take, literally 30 seconds, go on iTunes and write a short review. That would really help us a lot. I just wanted to read this interview, or this comment from Chris Collins, who is a friend. He says, this is one of his reviews. I'm just going on my phone here. It says, seems to always have great guests without ads, which is great, straight to the content in an understandable way. It's great for both beginner and advanced investors who are looking for passive income from investments. So thanks for that review, Chris. If you do write a review, I do read some of these reviews on the show. So please go on, write a 5-star review. It would really help us to get better guests for you on the Mailbox Money Show. So thanks for taking the time to educate yourself. We'll look forward to seeing you on the next episode of Mailbox Money.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.